Welcome to our weekly market review. It's brought to you by ETM Analytics and TreasuryONE. As per usual, I'm joined by currency strategist at TreasuryONE, André Cilliers. André, pop the champagne, bring out the streamers. It's the news that we've been waiting for since February, is that there seems to be, and I just want to emphasize that seems to be a peace deal, a final peace deal on the table between US and Iran. It is set to be signed on Friday. Still one or two niggles, and we don't exactly know the terms. But the one thing that we are looking forward to is the opening of the Strait of Hormuz. But, we've said this previously so many times. Even if this conflict comes to an end, it doesn't mean that we're going to be able to get rid of the negative impacts that's been, brewing underneath with the closure of the Strait of Hormuz. And one of that is, of course, the inflation. We're expecting South Africa's print out this week. We're expecting that increase to come. So with that in mind, the increase, yes, but surely at least there's some tailwind of good news that's going to eventually come through.
Yes, good morning to everybody. We have a deal. It's just not signed. To me, the difference here is the fact that we have a deal. At least we have a date of signature and we have a place of signature. We have sticky points regarding nuclear discussions. We have sticky points regarding when will frozen assets be released and so forth. But I think that all falls within the 60-day period once the deal is signed. So I think we have a signature on paper on Friday. So the oil price tells me that, the market tells me that. I've done wide reading and listening and speaking and so forth. And I think we will have a signature. Whether it will hold for 60 days, that becomes an interesting debate. And it does not mean that it will last longer than 60 days. But I think everybody realizes the importance of this. But you mentioned, and I've mentioned before, this does not mean that the sun is out and we can all go to the beach after Friday. It's going to take a while for ships to clear and come through the Strait of Hormuz. It's going to take a while for this to normalize and work its way through the markets and normalization stepping in. So let's hold thumbs, but it's not all over in the sense that it's lasted for over 100 days. It's going to take 100 days to normalize again.
Yes, and like you said, we're going to see the inflation pressures, that we're still going to see that reading, and you spoke about the oil. So for me, it was very interesting, and there are various theories as to why this has happened, but the oil did not really, breach $100 at a sustained level. We didn't see, worst case scenarios come to realize. A big part of that, of course, is what's been happening in China. They pulled a lot more from their strategic reserves. So that's when there was some demand destruction that's happened. But now that, theoretically, we do have a deal, we are expecting the oil price to come under some pressure, to ease somewhat. And that is, going to be the interesting development I think we're going to watch, because we must remember that before we entered this war, there was talks that one analyst group called it a super glut that was expected kind of for oil this year. So we expected very low prices for oil. Obviously, then the conflict happened, and now we are reopening the strait, and fairly so. You said, it's not just going to normalize overnight. Ships have to be comfortable that there won't be a re-escalation, which is unlikely given how close we are to the midterm elections in the US. So re-escalation is unlikely, but things need to start flowing. We also must remember that companies like Aramco in Saudi Arabia, they can't just flick a switch and put the refineries back on. It's going to take a while. So we are going to see this easing, and the renewed demand is also going to come from strategic reserves that need to be replenished. Again, so for the outlook for now, and this is good news for inflation and interest rates going forward, at least there should be some relief coming from the oil price that's going to come down from this conflict?
You see, this is economics, and the nuts and bolts of an economy is going to start taking over now. Now, an interesting one is in this month, we have the Federal Reserve having their first meeting under their new president of the Reserve Bank, of the Federal Reserve, Mr. Walsh. Now, are they going to go, if you look at the inflation figures that came out, it came out 4.2%, but that includes food and energy prices. Exclude that, and you are at 2.9%. So not too much of a jump, fairly stable. So it's just the energy and food, and that can be ascribed to the war. If that's now over, are they going to let this glitch, if we can term it that way, influence their decision? Or are they going to be forward-looking and say, with the war now over, with oil prices normalizing, with fuel prices and energy coming down, food could stabilize, and we did expect interest rates to go down, and we can be less hawkish, more dovish, and maybe at the next time, if the war stoppage lasts, actually start lowering interest rates. It's going to be really interesting to see what comes out of that meeting. The first one, and a very interesting situation developing in the world around that. My view is that they might not be as hawkish as a lot of people expect, and that will be more forward-looking and more positive about a war that's actually over.
Well, I know which one Trump would like Walsh to go with. So, we will have to see. He really came in at a very tough time at the Federal Reserve, so it's going to be interesting to watch this week. But overall, sentiment is lifting due to the peace deal that's going to be signed, and that's a good thing for emerging markets, including the Rand.
Well, including the Rand, our monetary policy committee was actually forward-looking negatively, saying fuel prices will be elevated for a long time. It would filter through to higher inflation. We expect inflation to come out fairly elevated, more closer to the 4.5% level, and that would be underlining the negativity that Mr. Netanyahu and his team had when they made the decision to increase interest rates. Obviously, if the situation now changes, it could lower interest rates or lower the pressure on inflation, rather, not immediately lower the pressure on interest rates, because they would want to see a turn in that. In the meantime, the dollar is quite a bit weaker than what it was last week because of this new memorandum of agreement and the ceasefire. But that simply sort of brings the Rand, and I've spoken a lot about the 25.75 trading range. And I said, if there's an agreement, it could break the 25. It's exactly done that. So we could now trade, I want to say, if it is signed and going forward, most probably change our trading ranges to a 15.80, 16.20. But I don't think much stronger than that. And obviously, if it doesn't get signed, we'll go back to the 25.75 range. But for the moment, with emerging markets generally expected to be better, less of an emphasis on money flowing into America as a safe haven because of the war situation, we're in for a little bit of positive times.
Yeah, I think everyone's going to hold their breath until the signatures are on this paper. But one thing is for sure, the conflict took the elevator up and it's going to take the stairs down. So we can expect the impact that this conflict has had to unwind very slowly over the coming months. And it's going to be interesting to see how the likes of the Fed and other central banks are going to read the room and look forward, or how they're going to handle that situation. André, thank you very much for your time, and we will chat again next week.
Thank you very much.